Hello everyone, I am Dr. Surbhi Goyal and today we are going to talk about introduction to investment and speculation. The first question that comes to our mind is what is investment? Is it something that we are earning? Is it something that we are saving? Or is it something that we are putting to the market? So let's see what is investment. So when we talk about this term investment, that specifically relates to the money we are investing in the market. So we have our income. After deducting all our expenditure from our income and after keeping some contingency amount, the amount that we are investing in the market is called investment. But there is a condition. We also look forward to certain capital gains from there. So investment is an amount that we are investing in the market to earn certain gains. But is it complete? No. One more thing is there, that is the time period. So maybe I want to get some returns in 1 year. So that will be my time period. So when I am doing investment, I have to see what is the time period, how much I am investing, and what are the gains that we are looking at. Now, if we go by the financial term, then this is called investment. But if we look at the economic point of view of that, then investment is specifically that thing that is going to improve my economy, country's economy, and specifically the motto for which I am investing the returns of that. So, in totality, wherever I am getting some capital gains, that becomes the part of investment. One misconception is there that investment is equal to speculation. You know, when we invest in the market and we look for the same day returns, we want to get higher returns. So that is known as speculation, but no, it is totally different from investment. Speculation is that short term profit that we are getting from the money being invested within that day, looking at certain interest or certain gains within that time period. Okay, so let's say if I am investing 100 rupees right now and now I know that market is going to be up because there is some positive news about a company. So looking at that particular thing, I will put a bid in the market that okay, if I want to purchase a price of share, let's say having the face value 100, so I am going to purchase it at 1 rupee more, that is 101 rupee. So I am putting a bid of that, but actually I am also getting a seller of it. So my speculation worked and I got that much amount. Of course, with the lot size, that amount is going to differ. So when I am not focusing on any particular motive behind it, then it is a part of speculation, and the person who is doing it is known as speculator. Also, another risk in there that the risk on investment is quite low in comparison to speculation. I am putting my bid, but maybe there is no buyer, and when in the stock market we all know that a bid is complete when we have a seller against a buyer. So that type of risk is higher in speculation in comparison to investment. Also, when we invest, we use our money. But generally, when we go for speculation, we use other funds. We take loan from people, we take some other amount to get higher profits. So that is how the speculation works. Now, why do we invest? So there are 5 motives behind investment. We do invest to get returns. First of all, we want to earn profit, and that is why we are investing. So how to calculate the return? So for that particular thing, we have to see what is my timeline. Okay, so let's say today I am investing and I am expecting some certain returns at a time period. Fine. So future is unpredictable. How to see? So what I'll do, I go for the historical data. So let's say I have some investment, I want to do some investment today, and that time period I'm keeping is 1 year. So what I'll do, I'll go to some website like moneycontrol.com or yahoofinance.com or even the websites of BSc or NSC. We'll get the data from there which was 1 year before. So we'll get today's price, today's closing price we may refer, and 1 year before closing price. So we'll get two things in hand. Plus, we will take the amount of dividend being declared in that particular year. Now, what is dividend? Dividend is the amount which a company promises over and above the returns. Okay, so basically that is something which a company go for when they say ki we are very good, okay, we are keeping good financially. So they keep some amount as a policy to be given to the investors. You can take it as a retention bonus for them, right? So that amount is being kept. So they will take the return which was there earlier, then they will take the return which is being offered, or maybe the stock price which has been offered. They will take out the difference, and the amount of dividend which has been offered in that particular year is also been added. The whole divided by the previous year or previous stock price into 100. So this will tell us the whole return amount. So this thing you can practice anytime. Okay, whenever you think that I want to invest in some equity, so you can take out the data of that particular company from any of the mentioned websites, and depending on that you can just compare what are the returns I am getting in a particular time period. Maybe there are certain shares which are of long term, so you can have to wait for that particular long term to get those returns. Okay, so the first is return. We will see how much return I am getting. Second is the risk factor. See, when we are looking for higher returns, the risk is also higher. Okay, anything above the risk free rate is also coming with the risk premium. So you have to see how much risk you want to take, what is the percentage of it. So calculating that particular amount of risk premium is also important when we go for investment. Third objective of any investment is to see what is the liquidity. Liquidity simple means the conversion into cash. So how much easy it is to convert into cash. And when we are going for cash, we also need to pay certain charges. There are entry load, exit load, and there are certain brokerages and taxes, of course, we have to pay. So we have to see how much liquidity we are getting in, and after getting that, after converting that investment into gain. Fourth thing is the safety. How much safe it is to invest in a particular investment. Nowadays, there is a hype about cryptocurrency. But when it rises, it is rising very high. When it dips very high. Okay. So we have to see ki where am I going to invest? What is my risk taking appetite? So accordingly, I'll pick my type of return, my type of investment, and park my money. We had seen people who are coming from the X generation, they are saying ki hame FD kara lein chahiye, we should go for FD. But is it safe? Is it getting me that much return? Safety wise, yes. But returns, there are limited returns. So we need to actually make some portfolio in that way which will meet all the objectives. And the lastly, we have to see inflation rate. Right now, if I talk, the inflation rate is around 7. So if I'm getting, if I'm investing in somewhere where I'm also combating with the inflation rate of 7%, then what is the point of view? Just safe parking of money? Maybe that's my goal. But depending on what return I'm looking at, we have to see कि हमें कितना return we are getting after parking in the inflation. Now, the question arises from where are we going to get this information? The information of investment can be taken from various number of resources. There can be some information from newspapers, like we have various financial newspapers, Economic Times and Financial Express or so. We can take information from there. We can take information from government gadgets. We have various websites like I mentioned, moneycontrol.com or Yahoo Finance. We can take information from there. We can also take information from various news channels. And believe me, when you switch from one screen to another, like 9 o'clock it starts, the information is going to switch also. Okay, so you have to be very justifiable in knowing that आपका right information क्या है, where you are going to park your hard-earned money. This information is actually been processed later on. So we got the information from various sources, maybe, and the most dangerous one is the friends. Our friends recommend and we invest. Sometimes that turns into a big loss, right? So we need to be very, very cautious while selecting the investment alternative. Now the next thing is how this thing is going to process. So the first thing that is from a company point of view, When a company invests, they don't take the decision on the basis of certain pre-notions. They take the decisions in a very planned manner. So for a company, before investing, there has to be an investment policy, which will talk about how much money is to be invested, what is the percentage of it, how much returns are we expecting, are we looking for some short term gains or long term gains, who is going to be our investment manager, what all dividends are we looking for, what will happen to my goodwill if I am going to invest somewhere. All these things are going to impact your investment decision largely. So as a company, there has to be one investment policy. After having an investment policy, all the securities which are parked in with it are being analyzed. Okay, so these securities can be debt, these securities can be equity, these securities can be preference shares. So all those things are being analyzed, and a proper portfolio is being created, that what should be the proper mix of it. When a company is parking their money in debt, they have to actually wait for certain time period to get the proper returns. Fixed income you will be getting, but the money is going to be parked for some time. Equity gives higher returns, but yes, it is equally risky, as I mentioned, right? So we need to analyze the security as per the risk appetite of the company and the timelines when we are requiring those returns. Third thing is the valuation. Now, valuating the shares and valuating the debentures are different stories. The nature of shares are different, the nature of debentures are different, the nature of preference stocks are different. So we need to actually opt for a right method of valuating the shares when we are parking the money of the company. There are various models that we are going to discuss in our later lectures, though we have to actually select wisely where am I going to park my money. Then on the basis of my selection, I am going to construct my portfolio. Okay, what is the proportion of debt? See, when we are selecting debt, we also need to pay the tax. That we'll discuss later. So, how that thing has been materialized, how that portfolio has been designed, that how much risk I am going to take, how much returns I am looking at. So, that portfolio construction in itself is a big strategy to work on. So, that has to be worked upon, and later on we need to review our decision that whether the portfolio that we are creating is being giving us that much returns or not. So, this was about the introduction of investment. Now, let us move to the second part of the topic, that is securities. What is security? Security is not related to the personnel who is going to guard you. No. In financial terms, security is something which provides us a claim against an asset. As simple as that. If I am putting my, let's say, my board there, blackboard there, if I am selling it, then it can be an asset for someone. They are investing, but what is the return they are getting? Right? So they have to see at the returns. If I am just putting a car on sale, maybe there is a person who is looking at buying a second hand car, and there is a high utility for that second hand car for him, right? So for him, the claim, the returns that person is going to get after investing the money in that second hand car is very important. We always see what is the age of that particular car, how much miles has been run, what was the average that car was giving, whether it was petrol model, diesel model, or CNG or electric car. So when we look at these particular things, even that rule applies for a financial asset as well. This financial asset can be a fixed income security. This financial asset can be a variable income security. Fixed income security like debt, which provides you fixed income after the fixed interval. Okay, so they said we are going to give you 10% return. So that means the company is going to give you 10% interest on the investment you are doing. Okay, so that is a fixed time period thing that they are going to give you. So that is called as the fixed interest securities. But on a contrary, there are the variable income securities, which talks about that, okay, depending on the market behavior, we are going to give you the returns. And as we always read in the newspaper or whenever there is a mutual fund thing, that investment in capital market is subject to risk. Yes, that is always applicable. We always get some risk involved in that. We don't know how the market is going to predict. Like we had seen at the time of Russia Ukraine war, we are getting many minerals, many other things from that particular belt, and because of this particular war it was being impacted, right? Derivatives market moved like anything, or foreign investments moved like anything. So this type of impact, which is not predictable, that may happen in equity market. Even because of some companies' policy, there could be a bad reaction from the company. Or maybe there are big brokers which are playing around in the market and they push some company to some other end which is not expected. So such type of risk is always there in variable income securities. Now, when we talk about who issues these securities, okay, from where are we going to get these securities? So these securities are issued by government. Okay, so we do have the government backed securities, we do have in bonds, infrastructure bonds, we do have certain type of securities which have been issued by government which are generally very secured. So those can be there. There can be some quasi government securities which are partially being backed by government and partially by some private players. So that can also be there. There are companies who issue their shares, debentures, preference stock for the investors. Those can be there. Then there are certain public sector enterprises which fall in place, and they also go for certain IPOs to get some IPO is the initial public offer. So they also get some offering for the public, wherein they ask for the partnership in the form of equity from the public, and against that they issue their shares to them. Now, after knowing the basic nature of securities, let's talk about the various types of securities. Okay, so the first type of security is equity share. All of you might have heard about stocks. Stock investment, high returns, high risk, right? So equity shares are those shares which are being offered against the ownership of the company, right? So when a company is going to issue the shares, that person who is purchasing the shares become the partial owner of the company. It can be 0.01% to even higher. But you cannot buy all the shares by your own. There are certain regulations of SEBI, Securities Exchange Board of India. Under that only you can purchase those securities. So these are the ordinary shares, and most commonly known shares in the market. We float these shares in the stock market. We have two stock markets in India, BSE and NSE, Bombay Stock Exchange and National Stock Exchange. So these two markets give us the platform to get some shares from the market, and against that they provide the ownership to the person who is investing in that. Now, generally these shares are not been sold in a single unit. They have been sold in bulk. So we call them lots. Okay. So lots are like a number of shares that are being compiled and been shared. So these can be like 100 shares lot, 150 shares lot, maybe 1000 shares lot. So when we have such type of bundles being offered, those are called as stock. Okay, so now we got the difference between stock and shares. Shares is a single unit, share, single share, but when we are putting into a bundle, a lot, it is known as stock. So when we invest into a company, what we do, we just first zero down at the company that we are going to invest, and then we look at what is the investment decision there. So there can be a mention of lot and the share price there. If that suits to my pocket and to my goal, I can invest my money in that. So that is known as the equity share. Now, why do people invest in equity? There can be three advantages of it. First advantage is that they want to get the return. Okay. So if I am looking at the higher returns, maybe 18%, 20%, so even higher, so I may go for equity. I may not get such type of returns in any such other type of investment. Second, what I am looking at, I am looking at some variability. Okay. If I want to withdraw my money from the shares even today, I can do a trading, intraday trading, and I can withdraw that money. So that variability of time is also available with equity shares. Third is the hedge against inflation. No other type of security is providing you this particular characteristics, hedge against inflation. See, when you are combating inflation, then of course you need to look at the returns which also take care of that inflation part. Okay. If in today's time a particular vegetable is getting expensive, that is an asset that we are purchasing. Same ways it goes with the financial market. There also there are certain financial assets which may get inflated or which may be offered at a higher price, right? So for that you also be ready that okay, you have that much buffer in your hand that if the inflation goes higher, you are getting the returns accordingly, right? There is a concept of time value of money which you have read in your financial management subject earlier. That particular concept is also applicable in capital market. So if you are investing something today, I need to calculate what will be the value of that particular something financial asset in future. So that particular difference is need to be calculated, and that should also cover the inflation part of that particular time period. So this inflation actually plays a vital role when we select among fixed income security or the variable income security. So this was a brief introduction about equity. One more thing I would like to add here, these all people also get the voting right. Okay, as an owner, I want my team to hear to me. So that right is being given by these equity shares. Now I am an equity shareholder and I had parked my money through the company. The company is using my money. What company is giving me in return? They are giving me dividends, timely dividends. If they have the policy, it's not compulsory for all the companies to give dividends, but many companies give that so that they can give a promise to their investor that we are going good, your money is safe. Along with that, they also offer bonus shares. Now, what is bonus shares? This thing is first thing you need to know. This thing is being offered to only the existing shareholders. So, if they are having certain shares with them, along with those equity shares, few more shares are being added to the kitty. Okay, that is being done on a pro rata basis, and those shares are also being offered without any payment in cash. So for earlier equity shares you had made the payment, but for these bonus shares you are not paying and your portfolio is being increased. So when you will be selling your shares, then you can sell these bonus shares along with the shares you are having. Okay, so that is the benefit which is being given to the equity shareholders of a particular company if that company is offering bonus shares. Next is the preference stock. Now you will say ki we have the equity stock, then what is this preference stock? Preference stock is that stock which is also being offered to the individuals at a particular price, maybe higher than the equity share price, but against that you will not get the ownership. You will only get the fixed returns. Okay, so there is a twist here. We say ki debentures are there having the fixed returns. Now there are preference stocks which are having the high returns. So what is the difference? Preference stocks are basically do not have any voting right. They do not go for any ownership, but there is a perpetual liability on the corporate head. Okay, so they can give that particular stock to the individual at a very high return. You will now another ask you will ask now you will ask another question, that what is the difference between stock and preference stock? In preference stock, the amount of investment is always higher. Like for a equity stock, I said there can be a lot of 100, right? You can pay 100 for 100 lot and you will get a stock from that particular company. But in preference stock, the lot will be higher. For each particular share, you need to pay higher. Okay, so if you are having a high amount in you and you can pay to the company, then you can invest. For company, what is the benefit? the company issues preference stock when they have ample amount of idle money with them to return to the investor. Only then they will offer the preference stock, otherwise they will not offer the preference stock. Okay, so that is something which we have to see ki what we are parking and where is the surplus money is going to be parked. Now these preference stocks are also having a benefit of some flexibility of model. How? There is something called cumulative preference stock, wherein if there are preference stock of, let's say, having 10% return, then there are 11% return, then 12% return, I can accumulate them to create my own portfolio of that. Okay, so that is the first one. Then there are convertible preference stock. Now I have preference stock of, let's say ki 1 lakh rupees with me. That's just an example. So if I am having that 1 lakh rupees with me, I want to convert that into debentures. Okay, because in debentures you don't have any lock-in period now, a limited lock-in period. So you can get your money back. So you want to convert into debentures and you don't want to get into risk part. Okay, fine, that's your choice. So you can do that with the help of convertible preference stocks. Then there are redeemable and irredeemable preference stocks. So let's say ki, I want to redeem my preference stocks at any moment of time. I don't want to fall into that lock-in period thing. So that thing I can redeem if I am having redeemable preference stocks. And if I don't want to get into that particular thing, there can be a reason behind it. Now, if there is a redeemable preference stock, then of course that is having the higher charges. So just to avoid that, we can have irredeemable preference stocks which you cannot redeem before a particular time period. Also, there are certain stocks which are cumulative and convertible both. So these are the different types of preference stock which are available in the market. Now another type of scrip is debentures. What is debenture? It is a debt instrument, first of all, which has been issued by the company and which is carrying a fixed rate of return. So whenever there is a time period of being paying the rate of return or paying the rate of interest, the company is going to credit that amount in your account, and you need not to worry where that money is going, because that is something which is having preference over other liabilities. So if in case a company gets bankrupt, then your money is safe. It will be returned to you. Okay, so that safety part is always there. Along with that, there is also a part of fixed tenure. You need to park your money to the company for a fixed tenure, and after that you can redeem it. There are various features of debentures. The first is the interest rate. You'll get a fixed rate return. Redemption after a certain time period, only then you can redeem. And indenture. So in case of bankruptcy, you will get the amount in preference. And again, there are different types of debentures. There are secured bonds, which are generally being issued by government, infrastructure bonds or something like that. Fully redeemable debentures, which are having the higher charges, but you can redeem it any time. Then there are irredeemable debentures which can be redeemed after a certain time period, and there are non-convertible debentures which cannot be converted into any certain type of other security. The last part is the bond. Now this bond, like we do have certain other types of securities, this bond is very well and highly paid in a market. So when we are investing into bond, we are actually getting into very secure system, having lots of rules related to it, having lots of visibility, and having lots of regulations on it. Bond is also a debt instrument with a fixed interest rate, with a fixed time period, but these can be offered by various organizations. These can be offered by government, these can be offered by quasi-governments, these can be offered by corporates, and these can be offered by various financial sector organizations, maybe any public sector organization, those can offer it. When we talk about government bonds, then those are highly securitized bonds with a lower rate of interest. But when we talk about corporate bonds, these are highly rated bonds, generally not open for individuals, but there we can invest for getting very high returns and a very reputed returns out of it. So these bonds are actually having a very fixed interest with a fixed yield. Okay, let's say ki when I'm investing into a government bond, then the tenure of it will also be written 7 years bond, 10 years bond, 5 years bond, like that. So we need to invest in those bonds in that particular manner, and then after getting that particular amount, I can redeem it. But there are certain modifications in it that we will discuss in detail in our next class when we'll be talking about the valuation of bond. So that's it for today, and all things related to investment and securities are being covered in this particular section. Thank you.